Hey, folks, here we are. We are live Friday, September 18th, 2 days to my birthday, sitting here thinking about how do I put the icing on this week. This week has been phenomenal in actually doing what I wanted to do. I wanted to cover the blueprint. Monday, we covered part one, goal number one. Tuesday, we covered number two. Wednesday, we covered number three. Yesterday, we covered number four, the CFO mastery. And I want to take that to another level today. I just want to literally, I want to walk through all the pieces of this jigsaw puzzle that I have laid out before you to hopefully give you a real picture of a vision, to be able to see the picture that I'm trying to present to you through this process, and how important it is to understand this as we start every day under the current circumstances and atmosphere of America and literally the world. We start out today with prayers for people that are affected, impacted by COVID, the little ones, the kids that aren't able to experience school in a traditional sense. It's going to have long-term psychological ramifications, I'm sure of it. Those that are affected by COVID, they've lost their job, their income is struggling, they're behind on their payments. Our heartfelt prayers go out for you folks. You know, it's hard enough to sit here and look and figure out, you know, I want to help pay for the kids' college. I want to be able to retire someday. I want to be able to save more money. I want to be able to get out of debt. And just like life, as soon as I think I found a way to start moving forward, crap happens. And that's the COVID-19 is now the current crap that has happened. And our prayers go out for those that have been lost to this crazy high-end flu, as I would call it. And our prayers go out to everybody that is impacted in some way with this. So with that being said, it brings all the more importance to what I'm doing and what I talk about to bring you the truth about finances. Because looking at the future, you know, I had a couple of meetings yesterday with people, and we ended up talking about the US debt clock and so forth. And somewhere out there, I posted a video yesterday by Robert Kiyosaki talking about gold and silver. I don't know whether we're ever going to come back from the brink that America is in with the current level of unfunded liability of over $154 trillion and another $26 trillion on admitted debt, that this year alone, they're probably going to end up adding $4 to $5 trillion to that debt because of the current circumstances surrounding us. It makes it so much more important to be as efficient as you can be with your finances, to get out of debt as quickly as you can, to learn how to manage your cash flow and monies in a very different way than you have been led to believe is the right way. Because remember, we're going to start with basics today, and I'm going to go through this and try to explain, you know, what is the PhD level? And you know what? I'm not even sure I'm at the PhD level because I continue to learn every day, because I participate in conferences with other like-minded people across America like myself. And I continue to hear creative ideas from other people that are learning what I'm teaching, and they're participating in what we're trying to bring to everybody in America. It is so important to understand this stuff. And I humbly apologize if I have not been able to communicate it to you in a way that you feel it is that important to make a decision to start garnering this information and learning how to use it. So if we start with rules, and let's start with the financial world, you know, the banks and Wall Street. Now, please, there are some wonderful people that work in the local banks. I know them. I know lots of people that work in the banks. They don't even have a clue. Here's a word for you today. You know, people that are clueless, they're acluistic. There's a word for you, acluistic. Even the local banking people, they have been brainwashed to think in the traditional, typical way about money. And they participate and do their job. Their job is four rules. I want all your money, so their job is to get you to deposit your money into their institution. How much of your money? All they can get. They want all the money that you will easily deposit into their institution. Rule number 2, they want more ongoing. They want to set it up. Your employer can direct deposit your paycheck right into your bank account. Remember, I talked about this the other day. If you look at your bank account statement, you look on there, and this has no meaning to you whatsoever, but what it says is average daily balance. Now, to the bank, that's money in the bank, and that average daily balance gives them a balance sheet and knows how much money they can loan out of your money that's sitting in the checking account, because it's the average daily balance. It's the money that's always there. You don't run your checking account down to zero. Very few people do that. So there's always a balance that you keep in the checking account. So that gives the bank more money to loan out to other people and start the fractional banking concept. Remember that, the fractional banking concept? The fractional banking concept is simple. Every dollar that the bank has, they can loan out to other people. When they loan it out to other people, don't you have to put up collateral of some kind? Every time you get a bank loan, you know, whether it's a home equity loan, home equity line of credit, your mortgage, your car loan, or whatever it is, a loan at the bank typically requires collateral. And when you put up collateral, that's an asset of the bank that they can now take to the Federal Reserve window and leverage that asset and borrow from the Federal Reserve System, the banking cartel, as I would easily refer to it. They can borrow on average 95% of that value back again, so they can loan it out a second time. And then they get collateral. Then they go to the window, they borrow again, loan it out a third time, a fourth time, a fifth time, a sixth time, a seventh time, on average, 7 turns on the dollar. It's how the banks make money with nothing. You and I can't do that, but you have to understand their rules and why those rules are there. They're about profit for the bank. They're about profit for the stockholders of the bank, because there are stockholders, and the operation of the bank, the allegiance of the board of directors are to the stockholders. I want all your money. I want more ongoing. Number 3, I want to keep it forever. Don't ever come back. I want to keep it here in my financial institution forever, so I can just turn this thing over and over and over again and continue to make more and more money on your money. Oh, don't worry. We're going to pay you some interest rate. So you're just going to get that compound interest rate on your money, and don't worry about it. Don't worry about it. You don't need to know what we're doing. You don't need to understand this. It's how we make money. You couldn't do this, but we this is how we make money. What things are you promoted to do that make that number 3 work for them? I want all your money. I want more and go. I want to keep it forever. How do they do that? Well, isn't that what happens with IRAs and 401ks and pension plans and 403bs and 457 plans? Those are all government programs that allow you to supposedly save taxes. You don't save taxes. You don't pay it today. You postpone paying the tax to some future date, and they've told you, oh, don't worry, you're going to be in a lower tax bracket. Yeah? Is that your plan, to be in the lowest tax bracket in the land? It's not mine. I want to be in the highest tax bracket in the land, because if you're in the lowest tax bracket in the land, it means you're broke. You don't have any money. You don't have enough income to enjoy life. You don't have enough income to maintain your lifestyle throughout your life expectancy. You're broke. Is that what you want? That's what they're telling you that you want. Remember, we are told what to think. Nobody is encouraging us to learn how to think. That is what I'm all about. I want you to learn how to think. Because you put all that money in that IRA, 401k, 403b, all those accounts, and you put it there to at least age 59 and a half before you can get it out without a penalty. And even after that, it's all taxable. Every dollar is taxable. And in my experience, helping people plan for their retirement, what they don't need at retirement is more taxable income. I wish it was tax-free. Well, you could have planned for it to be tax-free. I could have shown you how to do that. But you were brainwashed, and it's not your fault. It's the marketing and advertising and the news media that constantly clouds your thinking with this information babble from the financial institutions that clouds your thinking. So it prevents you from thinking correctly. Because the minute you start thinking about what I'm teaching you about, you'll hear the next advertisement on the radio or the TV, or you're reading something and there it is. Put all your money, all you can, in your 401k. My textbooks from my COU course, my chartered financial consultant degree, and that certificate that I have, all of those classes I took, they all told me the same thing. Tell your clients to put all their money in their 401k, maximize their 401k first before you do anything else. And you know what I have learned? Maximizing your 401k guarantees you will have debt. It guarantees you will not be able to save money that you have access to. Remember, it's the game. They want all your money, more ongoing, keep forever. Now, when you get to retirement with your 401k, do you take it all out in one big lump sum? No. You take it out in dribs and drabs, so you fall right into their rule book. Fourth rule, I want to give back as little as possible, and that's what happens. You get to retirement, and because you are taxed on every dollar of this money, how much do you want to take out? Most people, they don't want to take anything out. That's why the government created the required minimum distribution rules, where you must start taking the money out because they want their taxes. Remember the Willie Sutton story? Willie Sutton was a bank robber. He'd rob a bank, they put him in jail, he'd get out. He'd rob a bank, they put him in jail, he'd get out, he'd rob a bank. And one day somebody asked him, Willie, why do you rob banks? He says, that's where the money is. Well, the government is sitting there looking at $154 trillion of unfunded liability that they're going to ultimately have to fund. There isn't enough money in America to fund that. They're looking at the 26 trillion, which is on the books right now. And that's a story, because in 2008, that debt was around 8 trillion. The 10-year Treasury interest That's the interest they would have paid you. If you give them $10,000 and buy a 10-year treasury note, they would pay you 6% interest. That was always recognized as the benchmark interest rate. The benchmark, 2008. The banks crashed because of the failed derivatives in the marketplace. And it was 1/4% of the derivatives that failed that brought down the whole banking system. And it caused the government to go to the Federal Reserve and print up a couple of $1 trillion. It ended up being like 3.5, 4 trillion that they printed up and put on their balance sheet to bail out the banks. AIG and several other companies, General Motors, and all of them that got bailed out with our tax money because a bunch of fat old men making decisions in these companies made bad decisions and the government bailed them out. Oh, they're too big to fail. Horsepucky. I'm serious, folks. We need to get a grasp on how to think properly about things. I hope I'm getting your attention today. I really am. These 4 rules are the most important rules for you to understand. Now, that's on that side of the table. Now, let's go to your side of the table. And real quickly, what are the 4 rules of the blueprint that I've created? Number 1, you have to save 20% of your income. New rule. And no more than 5% of that 20, 1/4, no more than that, 1/4, 5% goes into your 401k if there's a match. If you're not getting a match, all you're really doing is postponing the tax on your money till you know it's going to be higher, and you have no access to the money between now and then, so you are now forced to go to the bank and borrow money. You are forced to have credit card balances. That's simple. It's the game. It's the game. They want you to be dependent on them. They do not want you to be financially independent. That's what I want for you. I want financial freedom for you and me and everybody that I can help get there. Rule number 1, save 20%. Rule number 2, you accumulate 50% of your household income in accessible cash, where you have access to it without a penalty, without income taxes, so that you can avoid ever having credit card balances or having consumer debt or maybe even car loans. But when you do that, now, number three is no consumer debt unless you own it. You have to take ownership of your consumer debt. Now, what do I mean by that? Well, if I buy something and I can't pay for it out of 30 days of income, I have to carry a balance. So I'm going to keep a balance and I'm going to pay my savings. You have to treat yourself like you're an individual and your savings is all a separate entity. That's where the CFO idea came from. You're the chief financial officer of this financial institution that you own. That's what I'm trying to teach you. That I'm talking about the PhD level here. It's not piled higher and deeper. Well, maybe it is cash piled higher and deeper on your side of the ledger. So now you capture the opportunity cost on your money. Because remember the goal, how much do I need in the future at some future date? All I can get. All I can have when I get there. I want to have the most I can have when I get there. Well, how do I do that? Well, then it's an efficiency plan today. You have to be efficient with everything you're doing today to avoid losses. That's the uniqueness. When I meet people out and they say, what do you do? I said, that's easy. I work in the financial services industry. And right away in their mind, they're thinking, oh, this guy's a financial planner or whatever. But I have a very unique approach. My approach is I believe that avoiding losses will make you more money over time than chasing interest rates. Because the more you chase interest rates, the more you bring risk into the equation. And I don't think you should do risky things and risk your money involved in the stock market or those kind of things until you've accomplished at least the first three of the goals. Saving 20% of your income, 50% of your household income in accessible cash, and no consumer debt. Then the opportunity door opens and you start putting money into the stock market. You know, in March, when the market went from 29,000 on the Dow to 19,000 on the Dow, and the government started talking about trillions of dollars to bail this thing out, here I am, and I borrowed from the life insurance company 20 grand, and I took that 20,000 and I put it into my managed account. I don't have a lot of managed money, but what I have is managed, and I put money in the market when the Dow was only at 20,000. Well, it's already back up to 28,000, headed for 29 and beyond. Do you think I'm happy with the money that I put into the market? It was an opportunity that I could take advantage of because I had the capital available to me. Rule number two, 50% of your household income in accessible cash. So I was able to take care. We're 25 minutes in. Next week, we are going to continue this PhD discussion, and I'm going to pick apart little pieces of the blueprint, and we're going to continue to learn how this thing works. I don't want to leave this conversation until I have covered every element, every inch of what I can teach you, so that there is now going to be a series of these podcasts that will give you the education you need to understand all of this. You need to get my book, The Family Money Farm, the CFO Project, because that is really the PhD level. That's where you start capturing the economic human life value of everybody in the family, so that that value starts to create generational wealth. And you can create that, folks, with no additional out-of-pocket cost by implementing some of the strategies that I teach people. Imagine that. You can capture wealth and create more wealth, not only for you, but when you die, it passes to the family absolutely tax-free, absolutely unencumbered by the government. If that sounds like a plan that you'd like to be involved in, well, here I am. You can get my book on Amazon, Barnes & Noble, major booksellers. You can email me. You can contact me through Facebook, and I'll send you an autographed copy, and I'll invoice you through PayPal. You can pay with a credit card. They're $20 plus tax and shipping. If you buy it at Amazon, I think they're $25 over there. So you get a discount. Second thing I want you to do is go to cfo-project.com. It's above my head here. cfo-project.com. Put your name and email address in. You will actually get a PDF, a download. Excuse me. You will get a PDF download of my complete book. If you want to do it that way and get it for free, download it as a PDF onto your computer or your cell phone. But when you go there, I'm going to encourage you to invest in yourself. Are you willing to invest in yourself? There's $47 to invest there, and you will get 4 more books. Life Insurance Will It Pay When I Die, which is the book over here. Live Your Life Insurance by Kim Butler. I wrote the foreword in that book. Jumpstart Your Financial Freedom, which is an ebook that I've created and written. And the fourth one is The Infinite Banking Concept by R. Nelson Nash. And that book, you get part 1. You don't get the whole book. The first part of the book is the concept. That's what I want you to read. In addition to those 4 books, you're going to get a 1-hour video that will change your life. It'll change the way you think about money. It will change everything. It will give you the basis for wanting to learn what I'm teaching you. Because there it is. It's examples of what I'm talking about right in front of you. So God bless. We'll see you on Monday. Next week, we're going to work on the PhD level of the CFO project. And we're going to cover little pieces, include strategies and everything that we're doing to go over this stuff in great detail. God bless. We'll see you next week. Let's find my little guy. There he is.